Welcome to The Explainer. Today, we are digging into the latest report from the online furniture giant Wayfair. And, the numbers tell this really fascinating story. Sales are up, profits are looking great, but the number of people actually shopping on the site is, well, it's shrinking. So let's unravel this puzzle together.
So how in the world can a company be growing and shrinking at the exact same time? It sounds like a contradiction, right? To really understand what's going on, we got to look past the pretty pictures on the homepage and dive deep into their Q3 earnings report.
And this really gets to the big question. After the absolute roller coaster of the pandemic boom and then that slump that followed for all of online retail, has Wayfair finally found its footing? All right, let's get into the numbers. Okay, first up, let's talk about the big headline from the quarter. And honestly, it points to a story of some pretty unexpected strength.
The biggest piece of news is this number right here, an 8.1% jump in their total net revenue compared to this time last year. In a really tough market for home goods, that is a significant leap, for sure.
So that 8% growth, what does that actually look like? Well, it translates to a massive $3.1 billion in sales just for the quarter. It's a super clear sign that even with all the economic headwinds, people are still spending money to invest in their homes.
And you can bet the company's CEO, Niraj Shah, was thrilled. In his statement, he didn't just talk about the sales growth, he made a point to emphasize that this is all happening alongside, and I quote, fixed cost discipline. So in other words, they're not just getting bigger, they're getting smarter and way more efficient about it.
So where did this $3.1 billion actually come from? Let's follow the money and break it down. Turns out, this growth comes from a really powerful 1-2 punch. So first, they shipped over 5% more orders. And second, the average amount of money people spent on each of those orders also went up. It's pretty much the classic formula for really strong revenue growth. And you can see that second point perfectly right here. The average order value climbed from $310 to $317. Now that could mean customers are buying more expensive things, bigger furniture pieces instead of just decor. And look, it might not sound like a huge jump, but when you're processing nearly 10 million orders in a quarter, those extra $7 per order add up incredibly fast.
And if we look at where this is happening geographically, the United States was the clear powerhouse. U.S. revenue grew by a really strong 8.6%, which seriously outpaced the 4.6% growth they saw in their international markets.
But, as impressive as all that sales growth is, the real jaw-dropper in this report might actually be the company's profitability. Seriously, this is where the story gets really, really interesting.
Okay, so to really get this, we need to talk about a metric called adjusted EBITDA. I know it sounds super complicated, but just think of it as a simple health check on the core business. It tells you how much cash the company's day-to-day operations are generating before you factor in all the complex accounting and financing stuff.
Now check this out. This slide shows a really fascinating contrast. So on the left, you see the official net loss of $99 million. Looks bad, right? But then you look to the right, and their adjusted EBITDA was a hugely positive $208 million. What this tells us is that underneath all the official accounting, Wayfair's core business is actually a very effective profit machine.
And just to put that $208 million figure into perspective, this is the company's highest level of profitability since those crazy boom times during the pandemic. It is a massive signal that their focus on efficiency and discipline is absolutely paying off.
Okay, but just when the story seems pretty straightforward, more sales, more profit, the customer data just throws a total curveball. Because when we look at who is actually buying from Wayfair, a really interesting puzzle starts to emerge. So, get this. Here's the first piece of the puzzle. Despite all that amazing revenue growth we just talked about, the total number of active Wayfair customers, people who have bought something in the last year, that number actually fell by 2.3%. And now here's the other side of the puzzle. At the exact same time their customer base was shrinking, the average amount of money each of those remaining customers spent over the last year increased by a healthy 6.1%. So yeah, fewer people are shopping, but the ones who are spending a lot more.
So what does all this mean when you put it together? Well, it looks like Wayfair's strategy is shifting. They seem to be focusing on a smaller but way more valuable group of about 21.2 million customers who are now spending an average of $578 each over the course of a year. And what's driving this higher spending? It's all about incredible customer loyalty. A staggering 80.1% of all orders in the quarter came from repeat customers. I mean, that's just huge. Wayfair is clearly leaning hard on a dedicated, high-spending core audience to drive its business.
All right, so let's pull all these different threads together. What's the bottom line? What does this quarter really mean for Wayfair?
The story of this quarter isn't just about growth. It's about profitable growth. Wayfair has basically shown that it can seriously improve its operational efficiency and make a lot more money from a smaller but deeply engaged and super loyal customer base.
And that leaves us with the big question for the future, right? Is focusing on this loyal, high-spending core a sustainable strategy for the long term? Or will Wayfair eventually need to solve the puzzle of how to attract new customers to keep that growth engine running? It's a fascinating challenge, and it'll be really interesting to watch. Thanks for joining us.